Which brings us to the thorny problem of how to fund the UBI without changing our tax or welfare systems or increasing debt or taking from other programs or increasing inflation. If we were to pay 20 million adults $500 a week each, that would amount to $520 billion a year, which is clearly unsustainable in Australia's $2 trillion economy. Fortunately, there are a number of offsets. Firstly, recovery of the UBI based on earned income would save around $213 billion. Welfare and administrative savings are estimated at a further $142 billion, and as the UBI is spent into the economy, it will generate additional economic activity resulting in extra profits that will deliver extra tax. We're estimating a further $35 billion in recoveries. Those profits will also flow out into the financial and international economies, relieving inflationary pressure in the real economy. We're estimating the outflow at $30 billion. As well, it's certain that technological deflation will continue due to automation, virtualization, and artificial intelligence, further relieving inflationary pressures in the real economy. We've estimated this at 1%, resulting in another $20 billion offset. Savings from improved health, lower crime and increased productivity are also estimated at $20 billion. Now, we recognise that these estimates have a wide margin for error, and I'll come back to this concern, but first we need to consider funding. Without funding, the offsets would still leave a $50 billion residual flowing into the economy each year. This inflow could simply generate additional growth as it is spent to signal previously unmet basic needs, or it could lead to inflation. So, to fund the residual UBI and to manage inflation, as we said, we're not proposing any change to our tax or welfare system, or increasing debt, or cuts to other programs. Now, we recognise that these methods could be used, but by leaving our current systems untouched, no one can complain that they are disadvantaged. Instead, we're proposing to fund the residual UBI by issuing new Australian dollars. Now, this might sound like MMT, a magic money tree, but it's not. There's nothing magic about how money is created, allocated, and spent into the economy. There's just a lack of common understanding. And this despite the now famous 2014 Bank of England paper that explains the majority of money in the modern economy is created by commercial banks making loans. It's that simple. Borrowers then spend the new Australian dollars into the economy to meet their needs, in the process underpinning growth and inflation. But there's no natural law that says bank lending is the only way new money must be created and allocated into the economy. So, given this is the reality, we can replace some new commercial bank lending with new UBI money from the Reserve Bank by simply increasing interest rates to damp new borrowings for non-essential spending. Now, how we designate and target what is non-essential is another topic, but by offsetting the money flows, there should be no additional inflation pressures due to the UBI. Overall, economic activity should remain at full capacity, but more would be directed to meeting basic needs and less on other spending. Importantly, it would replace some debt with sovereign money, helping to stabilise the economy, as Jeff Crocker explains in his book Basic Income and Sovereign Money. If inflation remains a problem, despite the offsets and despite rising interest rates to mitigate bank lending, as a last resort, we can impose a flat percentage tax on all spending. Now, the tax would be rebated to producers, so it would ultimately be paid only by the end consumer, just like GST. But unlike GST and like interest, the tax would not be included in the consumer price index, so it could not feed inflation. It would simply increase consumer prices, dampening demand across the economy. Now, combined with the UBI, this would result in the distribution curve shown by the blue line in this graph. Above the red line, those earning medium to high incomes will pay additional tax, while below the red line, the net benefit goes to those on zero and low pay. So despite everyone receiving the same UBI and paying the same percentage tax on spending, the net effect is steeply progressive. The tax circulates back to people via the UBI. And unlike interest, it would have a more immediate impact without feeding inflation. And of course, as the tax is imposed, the UBI would need to be increased to maintain its real value. This will leave us with three main ways to inject new money into the economy. First, the universal basic income to meet individual citizens' needs as their birthright, fixing the system failure. Secondly, to cover government deficit spending for additional public goods and services that we might agree upon. And thirdly, via bank lending to meet borrowers' needs. Now, we recognise that there are many other claims that people may make for this new money: better infrastructure, women's health, disability care and so on, which could all be delivered by additional government spending and perhaps bank lending. However, of the three ways to inject new money into the economy to meet individual and social needs, given people must have money, we believe that providing a UBI for survival must take precedence.